my triple header strategy, or what I call 3 easy pieces. So let's get started. Now, first, let's talk about building your own strategy, because it's very, very important that you not follow all the hardcore rules that what you see is you see all these kind of gurus in the marketplace saying, here's a strategy, follow it, blindly do this, this, and this, and you'll be successful, make great trades. I, on the other hand, tell you, I'm going to teach you my strategy, but I want you to tear it apart, put it back together as your own strategy. Because unless you do, you'll never understand all the ins and outs. You'll never understand when the markets are giving you the wrong pieces of information. Because I couldn't explain 45 years of my knowledge in one class. Okay. So there are probably as many trading strategies as there are traders, but not all trading strategies and trading plans are created equal. I suggest that you find some strategies and then build a trading plan around them. Now, there is a plethora of trading strategies available to you, but I also encourage you to create your own strategy. When you build and test your own strategy, you are the master and you understand all the ins and outs, and you are not just trying to duplicate my thoughts or someone else's thoughts. Now, you have to make too many traders get their enjoyment out of just making the trade. If you can get your enjoyment out of analyzing, watching your charts, finding the opportunities, filtering the opportunities, and throwing, I was just as happy when I filter out a trading scenario and throw it in the trash can because I've determined it's not a good trade. And later in the day, when I go back and look at it, I say, you see, if I would have made that trade, I would have lost my money. I feel just as good as if I just blindly jumped in there, pushed a button, made a trade, and made a couple $100. Okay. Your satisfaction and reward should come from the knowledge of knowing what you're doing as opposed to the actual trade itself. Imagine football players who practice all week, who spend their whole careers building, getting experts. They read their plays, they read their plans, they do everything. The Sunday game is only the payoff for all of those weeks of practice, all of that studying, all of that learning. So it's only the end reward, and that reward isn't worthwhile if you haven't worked for it. So I always encourage traders to develop their own trading strategies, time permitting. And that's the big term, time permitting. I'm not telling you not to take an existing strategy. Okay. There are several reasons why I believe it's important for traders to develop their own strategies. First of all, creating a strategy requires you to develop a greater knowledge of the market and its price movements. Secondly, when one develops their own trading strategy, they are tuned into how that strategy actually works, what will cause it not to work, and they will be in a much better place to make adjustments when needed. So even if you trade someone else's strategy, test it thoroughly, and in the process, make it your own as you learn the ins and outs of it and possibly adding your own little twists. Now, this is the time-consuming part, but it's also the fun part. See, if you can find your fun and your reward out of this, and it's something you could do in the middle of the night, when the wife or the husband falls off the bed and you got your laptop out, guess what? Instead of watching that stupid movie on TV, you can sit there and be practicing your strategy, determining it, trading it on a demo platform, and getting your rewards. For me, the real fun is testing out what I come up with. That gives me the sense of fulfillment and the sense of joy. But before we can test, we need an idea. So how I generate ideas is by watching charts, both past and real time. No matter what time frame I'm viewing on a chart, I look for moves where there was money that could have been made. Okay. If you look at Apple or Google and say, oh, look at that. You know what? Google's been steadily going up for 3 days. I could have made a good trade on Google. Okay, how would I have seen this trade? What pieces of information would have told me that there was an opportunity here? You're backing into it because you don't care about the trade with Google. Okay, what would have told me about this before it happened? Or what would have told me about it when it was happening? Okay, now, okay, if I use those tools and put them together, let's see if that works on something else the next time and see if it actually does work. And if it doesn't, let's tweak it a little. Okay, because what you want to do is you want your strategy to interpret market moves, not all of them. You don't want it to give you lots of trade signals and lots of false signals. You'd like it just to give you a little few high probability accurate trades. That's it. So in short, you want to analyze your charts looking for opportunities, examine those opportunities, and construct how to turn those opportunities into real money without exposing yourself to excessive risk. Now, risk is an important term because too many traders, too many novices, too many experienced traders are all about their signals, their trading system, their strategy, and that's the smallest part of the entire battle. The battle is your risk. Okay. What you want is you want your strategy to give you high probability trades, but then you have to drop it into your risk management and your risk reward tools. And if and when, and which only happens rarely, if fits all of your risk reward ratios and your money management, then you can make that trade. So all your strategy is only giving you a potential to make a trade that might be successful. But could you afford to make that trade? Would you make enough money to cover your risk? If a trade turned against you, how much would you lose? Because ultimately, the whole idea is to limit your risk at all times. Well, if I were to look at the euro and the euro is moving, say, hypothetically, between 110 and 110.50, okay, and in order for me to make the trade, I've got to put my stop loss lower than 110.50. Okay. But when I calculate my risk, that's, say for the size contract I'm taking, that's a $2,000 risk. I can't afford to make that $2,000 risk. So therefore, even though I had the potential of making $2,000 to the upside, I can't make that trade. Now, too many people go sulking around about that. Well, yeah, I should have made that trade. Look at that. I could have made $2,000. Believe me, every time you risk more than you can afford to risk, okay, that one time when you say, I should have made that trade, go back at 5 other times that you would have made that trade and you would have lost your money. So see if the strategy worked on recent movements and look for 20 or more possible trade signals. Test and timing is the most important thing. It's all about filtering your inputs. Not all trading advice is good advice. Figure out where the advice has come from and how much you trust the source. This is particularly important when using the internet. There are lots of amateurs out there who think they know all about what they're doing, and they write blogs and they write charts and they upload things all over the place, and they don't really know what they're doing. And then you have guys out there who are just trying to build their names. You have other ones that are out there, they're paying some guy in India $5 to write this article, and he's taking some other article he saw somewhere else and just changing the words in it. And what you get is a bunch of gobbledygook because it wasn't even written by somebody who's ever made a trade, but it's shoved out there on the internet. God forbid you get it and you follow it. So when you develop your trading strategy, you'll start with a set of recommendations from analysts and other traders. So what you're going to do is you're going to start out tonight with a guide, not a guide, a strategy I'm going to give you. I'm a well-known quantity, but you're not going to take my strategy that I'm going to give you shortly blindly. You could take elements of it or pieces of it or say, you know what, I like that part of it. Let me use that with this. Okay. Because you don't have to reinvent the wheel. You can learn from trading analysts and experienced traders. They're still in the market because they're successful. Study their strategies and learn from them, but just don't follow them blindly. And always, always, always include fundamental analysis. Always be aware of your economic events, your news headlines. Anybody who says, I'm a technician, I only trade from what my charts tell me and I don't look at anything else. Well, you know what? All of that black box method works fine for big banks and hedge funds. It doesn't work for you and I because, see, we can't afford the risk of Mario Draghi making a speech. And even though were sure the euro was going to go down today, and the euro eventually went down, we didn't realize that Mario Draghi was making a speech at 2 o'clock, and that little speech created extra volatility in the markets. We got stopped out on our trade just because he said something at that minute, but then when his speech went on a little bit later, it reversed and everything else. But we got stopped out because we didn't pay attention to the fundamentals. Now, also, you don't have to have one strategy for everything. You could have one strategy that just gives you trading signals, that generates potential buyer sell alerts. You could have a completely different strategy for where you'd actually enter a trade. So online trading is considered by some to be one of the most challenging styles of trading, which is why it's important to jumpstart your journey with proven day trade strategies. See, I was lucky. When I started trading 45 years ago, the markets moved very slow. They didn't go around the clock. There was no online trading. I mean, there was really no, I mean, it was almost impossible to get news and information. We didn't have the internet. We didn't have TV news and financial news on TV. We didn't have cable TV. We barely had fax machines. What we had were ticker tapes. Yeah, that's how old it was. So the markets moved very slow. So you were able to learn, study, and also analyze your trades. We would spend hours sitting in a broker's office in the pit watching the data come through the ticker tapes while we were slowly charting everything by hand and doing slow analysis and deciding, oh, tomorrow morning I'm going to enter my trade on livestock at here, or I'm going to trade orange juice tomorrow morning if it's at this price. And this was at 2 o'clock the day before. Not that the markets are moving all over the place continuously. Today, we have so much being thrown at us continuously. We're trading in pips, tiny little denominations. We didn't even have pips then. So in order to build your strategy, you have to think differently than the pack. Trading is simple, but it's not easy. That's where effective trading strategies are vital. The reason it is not easy is because it's an ongoing exercise in psychology, and invariably, we get in our own way. To correct this, we must recognize how we have been programmed to think and then begin to think differently. In today's connected society, we are bombarded with information. Some of this information is important, but a lot of it is just noise. So a sound trading practice is not to take this information at face value. Rather, think differently and validate the statements about the product to see if there's a bona fide trading opportunity. Planning. The best way to rein in emotion is to have a trading plan and to read it daily. The hardest part for any trader, including you and me, is to keep your emotion in check. I mean, in 84, 82, 83, 84, I was trading and making so much money, I didn't know what to do with it. But my lifestyle kept expanding. My lifestyle kept expanding. I couldn't make a bad trade. 84, 85, 86, I had nothing. I had to sell everything. I lost everything I had because the markets turned against me. I increased my lifestyle, so I had to keep taking more money from the markets. And then I was starting to chase trades because up until then, I was so lucky that I wasn't even really properly evaluating my trades. It's like everything I touched in 84 turned to gold. 85, those same things turned to garbage because my strategies weren't time tested. And then I started chasing the trades, because I had to make the profit. I had to have the money coming in. I had to pay my bills. Well, I learned I was not too good at this because I've been doing this for 40 years. I can't be a professional trader. Okay. I can teach it. I can show you how. I can trade online. Okay. I can't risk my living on it only because I can't control my emotion. It is the hardest thing for anybody to do. I'm just like you. I mean, I get caught up in the moment. You know, IT told you about making that $2,000 possible trade and not making that $2,000 risk trade. But you see, what happens is inside my head, it says, I'll make that trade anyway. Okay. And that's where you can't do. Okay. So it's important for us as traders to refresh these criteria in our minds before trading. A solid trading plan enforces these points. And by reading our trading plan daily, we recognize the importance of being and begin applying them. So one of the most important parts of your trading plan is understanding yourself, because the market's all about psychology and understanding yourself, understanding your downfalls and how to control yourself. And sometimes it's a physical control. You know, a physical control is I only trade from 9 to 10, and then I can't trade anymore. So you tell the wife, turn my computer off at 10 o'clock. So then it's continued education. You have to learn. And too many people don't think this is, they think they know it all, they got it down pat. Well, when we're in elementary school, we learn our ABCs and our 1, 2, 3s. As our education evolved, we use these to build sentences and eventually solve math problems. You know, by second or third grade, you're reading sentences in a book. You know, you could do 1 and 1 equals 2, 2 and 2 equals 3. Look at that. By the time you're in 6th or 7th grade, you can do your multiplication tables, your division tables, and so forth. So the further our education's expanded, the more proficient we became. Okay, and this is just like trading. Too many people want to come into trading and skip elementary school, skip lower school, skip middle school, and they're often in university working on their PhD. Doesn't work that way because our brain has to take in the knowledge and build it like we build sentences and paragraphs. Okay. And you got to fill in those gaps. So the further our education expanded, the more proficient we became, because our continuing education, we developed the ability to write pages of sentences and even solve quadratic equations. But could you have gone through grade school and then gone solve the calculus problem? No. Well, you know, if some of us were declared geniuses, maybe. So developing our trading prowess is no different. So to begin, one of the first things you should incorporate in your trading, and that I incorporate in my strategy, because we're getting over there because y'all want it, is one basic. And you'll find no matter what strategy I'm teaching you, I start out with support and resistance. Because in my world, this is the most important thing I can have on my charts. It is one of the most important price levels to make any decision. So the first part of my strategy is to apply support and resistance levels. Now, tonight, we don't have a time to teach you in detail about support and resistance. We have whole classes on just support and resistance. But remember, it's the peaks and the valleys made in our trading. It's the prices where the price moving up had a difficult time continuing up, or when price was falling, support held up that price from falling any farther. The important part is that you get better with identifying these levels where price changes direction and reverses. These areas are significant to a trader to be able to recognize where there are high probability areas for entering a trade at lower risk. So actually, let's go over to a live chart because I've got our Euro US dollar chart set up. Okay, so here's my teaching chart, and we're looking at the current live chart for the Euro US dollar. Now, there's all types of ways to put support and resistance on your chart. And this is the first part of our 3-part trading strategy. Now, support and resistance is best when you use historical charts. Okay. And so as you see, I've got mine colored yellow and red at this moment. Okay. These tell me from what hour or how old these lines were. So the red lines are prices that I got from going back to 1 hour or 1 day old charts, which takes me back several months. And the last time that this asset was trading in this range, I was able to find these levels. But as you can see, going back in the price of the euro hasn't been down this low in a very, very, very long time. So you can see the other levels when the euro was trading higher, because once you've got your support and resistance levels on your chart, they stay valid for a long time. But they only matter to you when the price is trading in those ranges. So all these red and golds at the top have no validity for us, because that's the support and resistance levels for when the euro was trading in the 112 area. We're down in the 110 brackets right now. Okay. So I went all the way back to when the euro was trading last at this level and looked for support in significant levels where the euro either fell and couldn't stay above or couldn't go break through. I drew these on my charts. Then I went from there to a 2-hour chart and went back again to see when the euro was trading at these levels and what prices were significant. I drew those on my charts. Then I went back to my half-hour chart and I found the prices that were significant on my half-hour chart. And these give me the levels of my support and resistance. And it's important to know whether these levels come from a more recent price movement or do they come back from historical prices, because they were important when the euro was at this price in the past. And because the only levels, you can get lots and lots of levels. You can get lots of these zones. And they're all valid and they're all good. You have to decide which ones are what we call major and which ones are minor. So I've removed all the charts, lots of minor ones where it hasn't had any reaction to price in the near term. Okay, and I've left on there only the levels that I drew forward that were of significance at this trading range where we are currently. They could be all over your chart, but then your charts get so busy and so complicated, okay, that you can get lost. So what we have are 4 levels of significant importance right now. 1, 2, 3, 4. Now, we can see from this yellow level, which is a historic level, how important, look at how important from the past. Look at what happened here when price was pushing up and it touched this level. Look at, we couldn't get any closes above this level. Okay. The other yellow level, which is also historical price, well, price here held that very, very well. Here, it was significant importance. When price broke through it, it wasn't able to stay below it and came right back above it. Okay, then we have our shorter term in red. Okay, this is more important because this is helping us adjust price. We can see right here, look how important that level is. We can see right here how important that level is. Look at what happened here when price bounced off the yellow level, came up to our red support level and bounced right off of it, stayed right at, because it doesn't really matter whether it bounced off or went through. What matters is what happened was as price came up here, look at where that close was. The traders pushed the price above it, but they couldn't hold it there because the bears pulled it down right down to that price. Okay. Look at what happened here. Okay. Then price rallied and moved back up, and it still could not break through that 110.40 level. So now we have some important levels for price. We have our 110.40 level. We have our 110.97 level. We have our 110.934 level and our 110.881 level. So this is part 1 of our strategy. We've now looked at price action. We've secured these price levels, and we are starting to interpret what price is doing. Part 1, that's just where we're starting. Strategy has to start off something. Right now, we don't have a clue to anything happening in the market, but we can see that these levels are very reliable at this point. So you can see here on this example chart also of how you can secure these levels. And every level that was important before can be brought forward and be still important today. The only thing I place on my charts is support and resistance areas. I use these support and resistance areas in conjunction with candlestick analysis to trade. I, on the whole, very rarely use any indicators. Now, that's not saying, I'm not saying anything is bad with technical indicators. Okay. If you think of price as someone, price is talking to you, you're trying to interpret what price is saying. Sometimes the market is so noisy that you can't make out what it's trying to say. Well, if you thought of an indicator as an interpreter, an indicator can help you interpret what price is trying to tell you, sometimes because you just can't see what it, or you can't understand what it's trying to say. So a simple moving average will take the noise out of the market. Sometimes you can't tell whether there is actually a trend up or a trend down. So something like MACD will help you see or stay on the right side of the trend. Because like I said, sometimes there's lots of noise. Now, support and resistance areas show you where to look for buy and sells that are a vital part of every trader's toolkit, and it's essential to learn how to place them. Now, there's lots of ways that you can place support and resistance. You can get them from Fibonacci levels. You can get them from moving averages. You can get them from chart patterns. Okay, I believe in eyeballing. Okay, because eyeballing makes you look at your chart, work with price, and understand what price is doing. It makes you and price work. You know, when you just push a button and drop something on there, you're not getting any of the personal feel. So even though it's more time consuming, it also allows you, after a while, you'll be able to see what these lines of support and resistance are. So you are now having your own interpretation of the market. You are bringing your experience, your knowledge, and your ability to that price, as opposed to using an indicator, which is just dropping them. You know, we have pivot point calculators, which will give you support and resistance by mathematical formula. Whoa, that's just a mathematical formula. It's not looking at price and interpreting what price is. So placing support and resistance areas is the most important skill you can master in trading. And placing them is easy. Support and resistance areas divide your chart up into buy and sell areas. And these areas sit above current price is a sell area, and the area that's below the current price is the buy area. So in other words, when we come to this resistance level, we would consider a sell. Our buy areas would be above the red, just be red, okay, and below, our sell areas would be right below the yellow, which is acting as resistance at this point, okay. Now, if price breaks through this, like this yellow was supporting price, the red was at some point supporting price, but here it was resistance. Because remember, support becomes resistance and resistance becomes support. But we have to look at it in relationship to price. So what we know is price is going to have a hard time breaking this yellow line here, which is its resistance. We can see all day it hasn't. You know, yesterday it wasn't able to. You know, it cannot. It's having a very, very difficult time. So when it reaches up to this yellow area, we would look. Now, this is not telling you to sell. We would look for sell opportunities. When it would come off of the lowest support level, here we would look for buy opportunities above, sell opportunities below. We would actually more define it between this level. We would look for buy opportunities because price doesn't look like it's going to come down to that level at all. Okay. Now, this is only the first step, so to speak. So let's go back to a PowerPoint. So when price approaches a sell area, large amounts of sell orders are being triggered, countering the buy areas. This usually results in price stalling or even turning around completely for a reversal. So why does this happen though? It's simple. The market movers like banks and hedge funds place their orders at areas of support and resistance. Good traders don't randomly place entry orders and hope they get lucky. They place their entry orders at significant price levels. Significant levels come in many forms. Okay. But we're using support and resistance. Okay. Now, in our explanation here of the pound, okay, in the pound chart example, we can see the price has stalled at the 130.70 level twice. We saw that also in the euro US dollar, not at the 130, but the 109 something. Because market movers place their buy orders at the 130.70, and when price hits that area, the buys trigger, causing a reversal. This happens all the time on every Forex pair, and it happens also on cryptocurrency. In fact, Bitcoin, it's kind of so obvious when these happen. Okay, it happens in gold and oil because this is how the markets work. Buy and sell orders are grouped together in the same general area, and when they are hit, we see the impact on price. Now, there are a lot of indicators out there that claim to give you great support and resistance areas. I tried them all and I don't find them reliable. Support and resistance placement still needs to be done by a person, you. These are my support and resistance areas, but if you want to trade more pairs, you will need to place them yourself. But don't worry, it's easy. All you have to do is place horizontal lines when you spot an area with 2 or more bounces. So the 3 rules for support and resistance. And like I said, this is the first step of our 3-part strategy. There are 3 rules you need to keep in mind when placing support and resistance areas. Place areas on the body of the candle. The body is more important than the wick. The more recent the bounces, the more important. Prioritize recent bounces over older bounces. When you need at least 2 connecting bounces to place a support and resistance line, but you need more than that. Okay, it's almost like a trend line. Trend lines, you can always connect 2 levels. You need more levels, and the more times the prices hit that support or resistance level and reacted to it or held it, the more important that level is. It would move a minor level to a major level if you saw price come down to that level again, bounce off of it, because that becomes more strategic and more important. So select the daily chart and zoom out when you see around a year's data. Don't worry if you see little more or less than 1 year. It's no big deal. Identify the highest and lowest bounces in the last year and place them on each end. Remember, place your areas at the bodies, not the wicks of each of these candles. Then move down to the lower chart and to the lower chart. You generally find that there are about 5 to 8 support and resistance zones areas on most charts. If you have more than 8, you're probably placing way too many lines. Now, most new traders learn a little bit about candlestick analysis because now that we have our zones, we need to then define what we're going to do. But so when you learn candlesticks, and believe me, I teach lots of classes on candlesticks, most of what you learn is useless. You know, seeing a harami, understanding what a bullish or bearish engulfing is, understanding what an evening star is or 3 white soldiers, all becomes really useless. Most of us, including myself, can't use and decipher all of these patterns in candlesticks. You know, when the markets were slower, it was a little bit easier. But today, markets move so fast, okay, and we're trading in very small areas. But candlesticks, because most people are taught candlestick patterns, not candlestick analysis. Okay, so the standard approach to candlestick analysis is through basic pattern recognition, which fails to work in real trading. You can't skip straight to advanced candlestick analysis without knowing the basics first. If you don't know the basics, that's fine. I got you covered. When Forex traders first start out, they usually learn about candlesticks. But what they learn is usually useless. They normally see a list of candlestick patterns, like the ones that we're going to show on the next chart. And each pattern has a set in stone definition, and that is the only meaning they can have. So we're taught to read what the hammer is and how to react when we see the inverted hammer, the doji, the spinning top, the shooting star, the hanging man, the gravestone doji, the spinning top, bear spinning top. Who cares about all this stuff? Everybody thinks it's interesting. Like I said, I teach lots of courses in candlesticks. But this is not candlestick analysis. This is pattern recognition. And for a price action trader, it's useless. Actually, it's worse than useless. Thinking about candles as just patterns is counterproductive. It makes you a worse trader. It leads you into make massive mistakes. Why? Giving a pattern a set of definitions leads to tunnel vision. When you see that specific pattern, you assume something will happen. But that's not how candlesticks really work. All candlesticks need to be assessed based on the candlesticks around them and many other factors. So normally people say spinning tops mean a reversal is imminent, which can be true. However, the same pattern can also mean that a continuation is imminent. It can mean that the price is temporarily stalling. It can mean a lot of different things. Thinking about candlesticks as simple patterns is the wrong way to do it. You need to look beyond these patterns and read the story of price. And actually, it's a lot easier for us who haven't spent days, weeks, and months learning all these candlestick patterns, learning all these funny names, because it's all about the story of price. Every single candlestick on your chart is telling you a story. When you combine those candles together, you get a story of price. So the foundation to my trading strategy is reading and understanding the story of price. So now we're getting to the gist of the strategy. It is vital because it allows you to answer one of the most important questions in trading. Who is in control of price? The question has three possible answers: the buyers, the sellers, or neither. Being able to accurately answer this question is vital. If you're about to enter a short trade and you ask yourself, who's in control of the price? And if the answer is the buyers, well, perhaps selling is not such a great idea. So let's break down the story of price. If you look at the three highlighted candles, it's easy to conclude that the sellers are in control. Okay. We don't need a name for this. We don't need any rules. Okay. We take a look at the candlesticks. But do we always get these three candlesticks? No. The candlesticks all close lower than they opened. So that makes them red candles. They all created new lows beyond the previous candle's low, and they all had small wicks in comparison to the bodies. The small upper wicks indicate that the buyers were unable to push the price up by much. But what does that highlighted candle in the next chart tell us? Okay. Because what we're less concerned with this, we're more concerned with this. Okay. It has a short upper wick, a small body, a long lower wick. This is what I call an indecision candle. Not an elaborate name, not a whole bunch of rules. It's just got a short body, long upper or lower wick, and it's sitting there. We don't even talk whether it's green or red. It's an indecision candle. Because when you had seen an indecision candle after a strong move downward, you should be seeing more downward movement. But for some reason, all of those traders that are in the market are having indecision. Indecision tells you something. It's giving us a clue, especially when we've got that indecision based on support and resistance lines or coming close to support and resistance lines. The indecision candle occurs when neither buyer or sellers can gain and maintain control of the price. They are common, but if used in the right way, they can be very powerful. So take a look at the bullish trend, which I'm going to show in a second, and it's a strong trend. There are several bullish candles headed towards a new area of resistance. The big bullish candles tell us that during that highlighted period, buyers were in complete control. So now we have our support and resistance levels on our chart. We see price moving upward. Forget that these are three pretty candles that we just drew on our chart. They could be all kinds of erratic candles. They could be a smaller one, a bigger one. We see price though moving in a steady upward movement. It reaches our resistance level because when price is moving up, the higher price is resistance and this is support. It reaches our resistance level, and what do we get? We get an indecision candle. That's a clue to us. It doesn't tell us anything yet, but that's a clue because we not only have an indecision candle, we have it coming after a strong movement, and we have it at a strategic resistance level. When price hits resistance, we get an indecision candle forming. Okay. This was the green highlighted one. So let's break this candle down into stories so you can understand why it indicates an indecision. We had a large upper wick. Buyers tried to continue the bullish trend but failed. Sellers took control of the price and pushed it down. We had a small body. The smallest bearish body shows the sellers were able to close lower than the open. This is significant because in the three candles before the price consistently closed higher than the open. This shows us that the buyers are losing power. We have a small lower wick. The small lower wick shows us that the sellers were not able to gain much ground either. This tells us the sellers are not strong enough to turn price around completely. However, they are strong enough to stall further buyer movement. Now, this happens all the time. But we're only concerned when it happens in a upward or downward trend and it happens at a support or resistance level. So altogether, this indecision candle forming right after strong bullish candles suggests a power shift from a decidedly bullish market to an undecided market. While sellers are not in control, neither are the buyers. But there is one more thing we need to look at. Because remember, we talked about three pieces of information. The indecision candle is forming on top of the resistance area. So if you remember in the previous or early in the class, we talked about resistance being a sell area and support being a buy area. So the image shows us three strong bullish candles headed into a resistance area, and then bam, price stalls and we get indecision forming on top of that area. This tells us that the sell area is working. When price pushed into these areas, sell orders triggered and buyers could no longer continue up. That is the story of price on this chart. And this story gives us a nice little price action trade setup. The price action allows us to take many different types of trades: reversals, continuations, raids, swings, breakouts, and scalp trades, to name a few. So the setup is, how do we spot a reversal trade? Reversals occur quite often, but if you do not know what to look for, you cannot trade them. So what we have is price moving up, hitting a resistance level, getting an indecision candle. Now, we can't know for sure what price is going to do. We got set up for a possible reversal. We would expect price to bounce up and come down. Reversals are one of the strongest price action setups and one of the easiest to trade because they occur so often. In fact, for Forex, trading strategies focus for years on reversals only. However, these days, I trade more on price action setups. So a reversal comes in three parts: the preceding trend, the indecision candle, and then the reversal trend. So the preceding trend, okay, in this case, we had a preceding trend down. Okay, so the preceding trend is a strong move by the bears. In this case, it was a strong move by the bulls. The preceding trend is very strong bearish move, indicate there's a lot of bears in the market. Here we show there's a lot of bulls in the market. Okay, the preceding trend shows that the bears were in control. So this would have the downward trend, we have the bears, and the opposite applies for bullish preceding trend, which would show the bulls and the buyers were trending towards resistance. Now, a preceding trend can be formed by as little as one candle if the candle is strong and covers a lot of price difference. I categorize it as a preceding trend for the purpose of reversal trading. Preceding trends are simple. If you see a strong move headed into an area of support and resistance, you can consider it a preceding trend. Just means what happened before. We're moving upward in an upward trend towards our resistance. We see this trend. We get the indecision candle. We've talked about what an indecision candle is. So a reversal setup would have one of three indecision candles. The indecision candles need to form on or near the support or the resistance level. If the indecision candle does not form on or near the area of support and resistance, as we show you here, it is not a valid reversal setup. Why does it need to be on the support and resistance area? An indecision candle is a bullish preceding trend indicates that buyers are losing control and the sellers may be gaining. However, an indecision candle does not indicate the price will reverse with any degree of certainty. So keep that in mind. An indecision candle indicates only one thing: indecision. Okay. So what we have is price moving up or down towards the support and resistance level, the formation of an indecision candle. We only have two parts of a three-part series. Now, you cannot take a trade based on solely on indecision. The image here shows indecision forming between support and resistance levels. If we were to enter reversal trades based solely on indecision, it wouldn't work out too well. We have the reversal trend. So a reversal trend is the third of the most important parts of our reversal setup. This is where we make our profit. After a preceding trend stalls at support and indecision forms, often we see a reversal trend. The image shows a bearish reversal trend forming after indecision. So we see price running up. That same indecision candle, but look at this case. This indecision candle was still a green candle, okay, but formed right on support and resistance. I just want to get these markings off of here. There we go. In this case, we saw a transition of power from the bulls to the bears. But where do we enter the trade, though? Okay, we're not just throwing, chips out in the casino. You know what a reversal trade looks like. You know what you need to enter after an indecision candle and before the trend reversal. So I'll show you how to use my trading strategy to trade reversals profitably. My trading strategy is built on reversal trading. It is now expanded beyond reversals. Entering trades does not need to be difficult. Remember, my goal is to keep everything simple. So it's about getting your timing right. Okay. So again, we talked about the preceding trend, the indecision candle, and the reversal trend. You need to enter the reversal trade after part 2, the indecision closes. Okay, not just form, and before part 3, the reversal trend completely takes off. Obviously, if you enter after the reversal trend takes off, it's too late. You also need to make sure you do not enter too early, as you could be entering a false setup. So in this chart I'm about to show you, you'll see how the preceding trend entered and you failed. Okay, because price can just continue in that direction. Failed trades happen. There's nothing you can do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for the candle close to get in. But I have tested this thoroughly and wait for closes, and waiting for closes, you get in too late. So in the chart I'm going to show you, you can see that the first candle in the reversal trend closing far from support. Okay. So in other words, you have to practice this enough you feel comfortable. Preceding trend, indecision candle. When this new candle forms and price starts rallying up, if you waited for this close, you would have lost all of this profit. So you have to believe in after this indecision candle at the support or resistance level. In this case, it's the support level, and price rises above that level in the next candle. You would enter at this point, because you need to capture this move. Now, one of your confirming decision makers is volume. When price bounces off of that the support line and it breaks that support line with the new candle, not the close, you should see volume increasing. If you see volume increasing, then you are ready to make. This means you miss out on a lot of potential profit, which is obviously not good if you wait to the end of that candle. The key to the reversal trading, or any trading for that matter, is right timing. So how do you do that? Okay. I have tested countless entry methods for the last 15 years. In that time, I have found 3 awesome entry strategies: entering on the new high-low, retracing entries, and distance entries. Okay. When indecision forms on the area of support and resistance, you can use the high and the low of the indecision candle as your entry point. So in other words, you've got your rally up, your indecision candle on your support and resistance zones. You would set your stop loss slightly above the high of the shadow, and you would enter when price from the next candle came below the low of the previous candle, or the wick of that candle. So this is where you would set your stop loss. This is where you would set your entry point. So in the image, indecision is formed on resistance after a bullish preceding trend. So we want to enter a short reversal trade. We set up our entry a few pips below the low of the indecision candle, and our stop loss a few pips above the highest point of the candle. In trading, high and lows are very important. If a new low is created from resistance, it indicates sellers are taking control of the price, which means we want to be short. Our stop loss sits right above the high. So here's the exact opposite for the uptrend. Here we have the downtrend, indecision candle in support, stop loss placed at the lowest point of the wick, our entry point when the next candle breaks the high of that previous candle. Now, where do you set your target? Because in order to put it into your risk reward ratio management tools, you have to be able to set a target. Targets are also easy. You need to make sure your target comes from major barriers, like the next area of support or resistance. So if you enter a long reversal from support, make sure that your target is almost before the next resistance area. The minimum risk to reward ratio I use is 1 to 1.5. This means that my target has a minimum of 1.5 the size of my stop. But that's where you would have to set them, and that's my risk reward. You have to determine what your own risk reward, based on your knowledge, your financial ability, the size of your account, what you're willing to risk. So here we have our stop loss, our entry, and our target. So this gives us all the key pieces of information we need to make a trade. If there's a major barrier like the next support and resistance area in the way of my minimum target, I skip the trade. In other words, if my target would have to be up here to cover my stop loss and my distance, then I am outside of my I'm outside my strategy, and therefore I can't make it fit my risk reward ratio, and I skip the trade. I always start out with my trend line, then I find my support and resistance levels, then I look at the price action, and finally I look at volume to confirm. This can be your entire trading strategy. In trading, a lot of people tend to overcomplicate simple concepts. So, sure, some of the concepts in trading are not the sort of things that you would do intuitively, but many things are easy. You just have to know what you are looking for. So thank you very much for joining us tonight. And I've given you 2 downloads. Please click on those handouts and download them now. One is the complete introduction to technical analysis from Investing.com, And the next one is how to build this 4-point trading plan and follow it so you have a guide to put it together. So thank you very much, and we'll talk to you again real soon. Remember, if you have any questions, go to www.alvexo.com, and they'll be glad to answer them. Look in their trading academy. I'm sure you can find all of the strategies you want to learn. So have a good night, and thank